Hi, everybody. Welcome to the first webinar of the BFG free webinar series of 2022. If y'all joined us last year, you got to see a little bit about what we're about and how much we love teaching all of these personal finance concepts. So we are so excited to be doing this today. Today's topic is something that people are always asking about or always curious about, and that is how do we teach our kids about money? And how do we raise our kids to be responsible with money? I'm Sarah Losi. I'm going to be your host, and I am so lucky today to have Eric Brotman joining me. He is the CEO of BFG Financial Advisors and the host of our podcast, Don't Retire, Graduate. And he's going to be teaching us a few things about how we can spread financial literacy to our own kids. So welcome, Eric. Thanks for joining us.
Thank you, Sarah. I'm excited that you're hosting our webinar series moving forward. A true pro.
I will do my best. I know I've got some big shoes to fill. So let's get started, of course, with our disclosure slide. Everyone see it, love it, and let's get started. So first, I wanted to ask you, when is it too early or too late to start teaching our kids about money? When is it the best time to start?
Well, you know, it's funny because the two things that married people fight about the most, and that couples fight about the most, are kids and money. And it's not usually both together. It's not kids and money as much as it's kids or money. But those are the things that can make relationships really tough. And one of the reasons for that is that kids grow up and learn almost nothing about money formally, either in school or at home. And they learn lessons about money, good or bad, from their parents by watching them. And sometimes it's watching them fight about money. And that then carries on to the next generation, and kids take that into their own adult lives and then their own marriages. So it really is a vicious cycle. And so I do think it's important to start talking to kids about money relatively early. Now, it's important to make sure that the education that you're providing or the conversations you're providing are age appropriate. You know, you're not going to have a conversation with your kindergartner about compound interest. But I do think it's a good idea to start talking about money with kids as soon as they're old enough to decide that they want item A versus item B, whether it's at the grocery store checkout or whether it's in a shop and there's 100 stuffed animals on the shelf. You know, a kid's going to walk in and want 47 of them, and I think it's real valuable, even simply to just say, you know, we have $20 to spend on a stuffed animal. And so we're only going to pick one, but you need to pick the one that you feel is most valuable. So that's real simple stuff when you're dealing with a young person. As kids get older, I think it's appropriate to start talking about whether you're going to have an allowance, whether you're going to allow kids to earn a little bit of money around the house. You know, some parents feel differently about this. Some feel like chores are part of being a member of the household, and others feel like it's okay to tie allowance to certain age-appropriate responsibilities. And so what I think is the right thing to do is when kids start to ask you about allowance, that's their signal that they're interested in figuring out how to have their own pocket change, so to speak.
Sure. Now, it's interesting. I don't think I started learning about money until I was 25.
Yeah, working here. Yeah, I think that's
right. Exactly. So thank you for all of my knowledge.
Sure.
But why do you think that is? Like, why is it that kids are not getting any of this education?
I think parents tend to try to shelter their kids, particularly if there are money challenges at home. I mean, you don't want your kid going off to second grade worried that you're having trouble making rent. I mean, that's not a pressure that you need a kid to hear, or that a car repair is going to be real expensive, or any of these other things, or tuition, heaven forbid. You don't want to create that problem for your kids. You know, at the same time, teaching the value of a dollar is getting harder and harder, and people are busy. And really, it would be nice if there were personal finance courses in schools. Some have started doing this. Some school districts around the country have done this. Some states have tried to do this. Most of them aren't doing it great yet, but they're getting started. And so the message is out. I've never met a single human being who didn't say teaching kids about money is it didn't say it's a great idea. It's all about the how and the who and the what's the format, and should it be a nonprofit or should it be a for-profit entity or should it be a school system? And so there's a lot of questions about the where and the how and the who, but no one thinks it's a bad idea. And I have not met that person yet.
Yeah, I don't think I have either. So you kind of grazed my next question for you, talking about
Mhm.
what are ways that we can do this age appropriately. And now you have a daughter. I don't even want to guess how old she is now. She's growing up so fast.
She
But
is.
yeah, I know you started having this conversation with her pretty early. What were the methods that you used, and how has that kind of developed as she's grown?
Well, it's funny because we had this conversation as soon as she approached us with an allowance conversation. I think she was 8 or so. She's going to be a teenager soon, and I don't want to talk about it. But she she was about 8 years old. And what we did, first of all, we explained that allowance is not a gift; it has to be earned. There had to be things that she was doing to earn that, and they were responsibilities. They were things like putting her clothes away and clearing the table after dinner, and they weren't anything. We didn't have our 8-year-old mowing the lawn, right? But we did take her to a craft store and have her buy 3 clear jars, and we had her make labels for them. And every week we gave her allowance. It started at $5 a week, and there were 5 $1 bills. And the deal was that every week she had these 3 jars, and she had to put at least $1 every week of the 5 in a jar marked long term. And she had to put at least $1 in a jar that said charity. And then the other 3 could be in any of the jars, and the third jar was fun. And so that was our way of teaching her to not only create philanthropy at a very young age, but also to understand that sometimes you have to save for things that you can't afford to buy based on your just weekly intake. So that became a very valuable exercise, and it worked great for a couple of years. I think it started to wear off at a given point. I think it's appropriate and helpful for a while. I wish I could say that it was a total home run, but I can say there were a few lessons learned that were valuable. One is at the end of the first year, we looked at how much was in charity, and just anecdotally, she rarely put only $1 in charity or in long term. Normally, she would put more than that because she'd say, I don't need this fund money this week, or I'd rather. So she wound up putting some meaningful money into the charity jar, and I told her that she was going to pick the charity, and we went online and we found one charity related to children's health and one related to animals, and they made her really happy. And I actually matched her gifts, so she got the understanding of what a matching contribution or gift might be. She chose the charities, and she was very excited to be able to make those gifts. At the same time, her long-term money, I took her to the bank, and we sat down with the branch manager, who was gracious enough to spend some time with my 8-year-old and a jar of $1 bills. But we opened an account for her. We opened that account, and I matched her deposit, which again was related to here's how savings can compound. It's a little bit difficult to teach a kid the value of savings when they get their statement and they see a penny of interest. I mean, really, it's hard to say, well, why would I do that? I could just have a bunch of fun over here with this. Why would I earn a penny? Um, but I do think it's nice for her to know that she has it. If you fast forward a couple of years, just this last couple of weeks, we were at the beach, and my mother, her grandmother, had given her some money, and we were in a store. It wasn't a lot of money, but we were in a store, and she wanted, of course, a stuffed animal, which is why I used that example. And my wife, to her credit, was not going to spend money on this stuff. First of all, it seemed silly to us, but it doesn't matter that it seemed silly to us. It meant something to her, and she said, "I'd like to use Grandma's money for this." Now, she spent every penny that Grandma gave her on one thing, and we counseled her on it, and we explained it to her, and that's the only thing she bought all week. So, and she's very proud of it, and she's very happy with it. So I think some of this has resonated.
I love that. And I love that there's kind of levels to those lessons that she learned, because not only was she learning about saving for right now, she's learning about saving for the future. And then she's also learning about the power of philanthropy.
She is,
And
and that made her feel really, really good. She loved doing that, and I want to instill that in her from a very young age, because I want her to be able to give back to those organizations that help her along the way, whether it's a school or whether it's another institution or organization, or just something close to her heart.
yeah, and being able to pick those out herself, I'm sure really um, amplified that impact that it had on her. And hopefully that's something she's going to just keep carrying with her.
I hope so. I would think so. We'll see. Jury's out.
We'll ask you again in 10 years. So we kind of talked about how you started that long-term savings and you got her a savings account. When should we start saving money? And should it be something that we're saving with our kids? Should we be saving for our kids? Is it our money? Is it their money? Kind of how do we navigate that aspect of it?
The short answer is both. I do think it's important to save money with your kids in a very small, age-appropriate way because it helps them learn about it. But you also need to be saving for your kids in a much more profound way, in a way that you don't necessarily want to tell them about at a young age, because $10,000 sounds very different when you're 8 than when you're 45. It's still a lot of money, but it's different when you're 8. It's all the money in the world. And so it's important when you start saving for your kids that you do it in a very meticulous and thoughtful way. We've seen a lot of people over the 30 years I've been doing this. I've seen a lot of people who put so much money away for their kids that they almost can't retire themselves, and that's a very scary thing. I do think that if education is important to you and your family, and you want to make sure that you can afford an education for your kids, which is getting harder and harder and harder to do, that you start saving early. We started a 529 college savings plan for our daughter as soon as she had a Social Security number, and just made monthly contributions. And the monthly contributions over 12 plus years have really added up, and it's going to give her more choice when the time comes. And so that we feel really good about. We've also done other types of savings for her, and we encourage clients to do a number of different things for kids. Now, our daughter's young enough that she hasn't gone out and earned a W-2 yet, but for clients whose kids are 14, 15, 17, and they have a summer job, whatever it is, whether they're working fast food or they're working as a lifeguard or they're doing whatever they're doing, it's so valuable to fund a Roth IRA for your kids as early as possible because it can compound tax-free for the rest of their adult lives. That if your kids earn up to $6,000 in a year, you can use your money to put it into a plan for their benefit. It's a custodial Roth IRA. It's their money, but ultimately you're the one saving it for them, and you'll give them guidance along the way. But it's an investment account that money goes in and it's never taxed again as long as it's used properly. And that's really powerful. The other I see you put on the blackboard here, life insurance. I think having kids insured in a way that creates, not only preserves their insurability, but also creates potentially an asset that can be gifted to them at some point as adult people, is great tax planning and a really wise way to roll money downhill from one generation to the next in a very tax favorable way. Sounds a little creepy at first because you're like, wow, why would I insure my kid's life? And may none of us here on this webinar or listening anywhere ever experience a claim like that. That would be the worst thing in the world. But my parents did this for me when I was very, very young. And my life insurance became a very important asset for me in my 20s. I actually used the cash in my life insurance to buy my first home. And then in my 30s, I used it to start this company. So what was a very modest gift into life insurance as one of those vehicles became a much bigger way to create wealth for me as an adult. And fortunately, there's been no death claim. I'm alive and well.
And we're happy every day about that.
Well, thank you.
Now I want to jump back a little bit. And also, everyone listening, there is a questions panel. So if at any point you have questions about things we're talking about or something that we didn't mention that you want us to, just drop those in the questions panel. I'm going to be keeping an eye on it, and I'm happy to get those questions answered. But jumping back to the college savings plans, now, college is getting ridiculously expensive, as everybody knows. And college isn't for everybody. So if you wanted to start saving for your kids' college in this 529 plan, what happens if they decide they don't want to go to college? Is there any other way to use that money?
Well, there are. One, you can use it for private school up to a limit every year. So that's a decision you may want to make depending on your geography and your kids' learning needs and so forth. The other is that beneficiaries on 529s can be changed. So if you have 3 children and you put money into all 3 of their plans and 2 of them go to college and 1 of them doesn't, you can use all the funds for the kids who do. So that helps. Yeah, I never want to see folks overfund a college plan because you don't want money left over in a perfect world. If you use it for something other than a qualified educational expense, you do pay taxes on the gains and a penalty, and it's not great. So you don't want to overdo it. But at some point in your family, ideally, whether it's your kids or even if it's your grandkids someday, there can be a benefit for having an education fund. You know, Sarah, you could fund a 529 right now and go back to school yourself someday, or you could hold it for your future children if you ever have any, or grandkids or whatever else. But you can actually name yourself as a beneficiary. And we've seen people do that just because some states offer tax benefits for the contributions. So there are people who fund 529 plans before they even have children. They just make themselves the beneficiary, and they can get a tax break in certain states, Maryland being one of them, where sometimes that's a really good savings idea because you can then change the beneficiary when you become a mom or dad.
That's really interesting. And now, is it only something that you can use for a traditional college, or can you also put that towards maybe like a trade school? Like, is there any other way besides like a university?
Well, the definition of qualified educational expenses is expanding, which is good because it's not necessarily only a traditional 4-year school. It could be 2-year, it could be trade. There are certain types of apprenticeships that can be covered by this. So, and it's not strictly in the U.S. There are some schools in Canada and elsewhere that will qualify too. So, I think it's worth looking at, and you can go online at savingsforcollege.com and find out all of the information in a very objective way. The website, to the best of my knowledge, isn't selling anything to anyone. It's just education. And you can look up the different 529 plans. I think there are about 80 of them. And they are all sponsored by different states. So we get asked a lot, you know, I live in North Carolina. Do I have to be in the North Carolina plan, for example? And the answer is no, you can use any plan you'd like, and still the kids can go to school anywhere. However, in some states, there's a benefit to using a specific plan. In Pennsylvania, you can use any plan you want, and you can get a deduction against your state income tax, and that's terrific. In Maryland, you have to use the Maryland plan in order to get any kind of tax benefit here. So every state is different, and that website, savingsforcollege.com, will give you the information.
Awesome. And then kind of jumping to, you talked about life insurance. I know there's a lot of different types of life insurance. Is there one particular that you're referring to?
Well, for young people, I would only do whole life insurance. I would not mess with any. There's no reason to insure kids with term insurance or something that's going to be temporary. In fact, I'm not even sure an insurance company would do it. And if they would, I can't fathom a compelling reason to do that. But anything that's going to grow meaningful cash value that is still an asset of the parents can be a good thing. It's also nice because it's one of those assets that while it's on the FAFSA for financial aid for college, it's not on. Let me restate that. I actually reversed it. It's asked about for private schools, but it's not asked about on the FAFSA for college. So if you have money in life insurance for your kids on their lives and you own it, it won't hurt their financial aid at college. It will be asked about by most private schools. They're onto this. So there's that.
They figured it out.
They figured it out.
And now, so these are also three accounts that you talk about as being really great for tax planning in general. So for everyone listening, if you want to learn more about that, we have a free ebook that Eric, you wrote, and we've published it online for free to download at lowtaxbook.com. So if anyone wants to go learn more about how you can use these, not only for your children, but for yourself, just for general tax planning, go to lowtaxbook.com and you can download that free resource. So now let's move on a little bit. And this is, again, you had touched on this in the beginning, but if you're trying to pay for your kids' college, or if you're trying to save for your kids' future, how do you do that while also being able to plan for your own retirement? How do you not let that derail your own plans?
Well, it's a great question. And the reality is sometimes it's not only delaying a plan, sometimes it's making a plan impossible.
Yeah.
And so, you know, I've had to tell people, and sometimes, you know, tough love is still love. I've had to tell clients, if you continue to put this much money away for your kids, you're going to have very well educated kids. Which one are you going to live with when you don't have any money? And I say that sort of tongue in cheek and flippantly, but it's 100% true. So I liken this to the airplane safety lecture. And I have a hard time thinking about the airplane safety lecture without thinking of George Carlin's version of it, which I won't share on the webinar. However, the airplane safety lecture basically says, in the event of loss of cabin pressure, these masks are going to drop down, oxygen masks. Please secure your own mask before securing the mask for others. That's an extremely difficult thing to do. I'm blessed to have never been in a situation where I've been on a plane where that's happened, but I can't imagine how difficult it must be to put on your own before you help your kid. But the reality is, if you don't do it that way, and if you could pass out and not be of any help to him or her anyway. So financially, it's the same thing. You must take care of yourself first. There are ways to borrow for college. There are alternatives to traditional college. There are ways to get grants and scholarships and work study and other things for college. You cannot borrow for retirement. It's the only thing in life we can't borrow for. Borrowing for retirement means living under a bridge or with one of our kids, or living without any reasonable dignity. And so if we sacrifice our own retirement savings to benefit our kids, what we are really doing is telling our kids, number one, we love you and we want you to do great. However, we also expect you to take care of us someday. And that's not necessarily a good thing. I mean, it's a hard thing as a parent. I want my daughter to have everything and everything else, but ultimately I don't want her to have responsibility for me and for my wife.
Yeah, that can definitely be challenging having to think about yourself before your kid. But if you kind of flip the way you're thinking about it, it's really thinking about them first, but farther down the line.
Yeah, I think it is. And it's so important to make sure you've maintained your own ability to function, your own dignity. I have told both of my parents, who I'm blessed to still have in my life, I've told both of them, you don't ever have to leave us a nickel, but please don't have us needing to pay any of your bills. We've got our own, plus we have our kid. We don't need yours. And I think that message resonated. Like, spend and enjoy your money. Make sure you take care of yourself. Don't worry about us. You got us this far. Um, I don't care if you leave us a nickel, but please don't have us paying your bills. That's really very, very tough. And the sandwich generation, which is folks say 40 to 55, 40 to 60, have parents in their 80s or 90s, have kids in their teens maybe. As a card carrying member of that group, I can tell you it's not easy to worry about your 80-something-year-old parent and your teenage kid at the same time. It's a lot. And to still run a practice or work one or more jobs and everything else, it's very, very tough. So it's important to take care of yourself first, despite the difficult psychological torture that may seem like it presents.
Yeah. Now, if you're able to help your kids pay for college, that's great. But if you're not, without derailing your retirement, this might be slightly off topic, but what should parents or even students know about student loans so that I know you're able to take out student loans for hundreds of thousands of dollars at 18 versus if you try to get a loan later, it's almost impossible. So how do we make sure that our kids are ready to take those loans out and understand what they mean?
Well, first of all, they're not ready to take those loans out. I mean, we're offering, banks are offering student loans in an almost limitless way and really hamstringing our young people for what could be not just a decade, but longer. And because of the power of compounding and the power of growth and time value of money and all these various economic concepts, because of that, if you have to pay student loans off and you take 10 years to pay that loan off, it's not just that you paid 10 years of interest. It's that you also had 10 years where you weren't adding to your own assets, your own investments. And just by very simple rules are investments, if they grow at X percent, whatever it is, they grow exponentially because you get interest on your interest. So as a result, missing 10 years is missing that maybe last doubling. It's a life changer. Having $100,000 student loan could cost you $1 million or more, not in interest, but in lack of growth or earnings. It could be a lot more than that. So I don't think it's helpful to take big student loans. Now, there are some caveats to that. I think if you're going to professional school where you can legitimately anticipate that there will be a higher income tied to a certain degree or background, then that's an investment, and that's a graduate school program. But undergraduate school, I think it's worth avoiding loans at all costs if possible. And if you must take them, make them modest. There are ways around this. You can use community colleges for a year or two. You can go part-time and work at the same time. You can have your kids take a gap year or become emancipated so they can file their own financial aid. And there are lots of different strategies. And there are companies who do this, who work with young people just on that kind of college planning. I would say it's a huge issue. And it's one of the reasons why it's being tossed around politically in Washington and all over is this student loan issue. I think young people were largely sold a bill of goods that if you borrow money for college, you're going to get a better lifestyle and therefore it's worth every penny. And that's not necessarily always true. And we're seeing we're reaping the outcome of that. And not to wax political on what we should or shouldn't do about that, but I think it's important to stop that behavior. We don't have to hamstring another generation that way.
Yeah, I agree. I know my parents helped me cover the cost of my college, and I can't even imagine how different my life financially would be if I had all those student loans. I see my friends struggling with them still, and it's insane. I'm very grateful that I'm not in that group.
I think that
So let's move
qualifies as a
on.
shout out to your mom and dad. So, all right.
Shout out to mom and dad, Mr. and Mrs. Losi. Thank you. Thank you. So now, we all, like you said, you don't have to leave anything to, you told your parents they don't have to leave you anything, but if you are going to be leaving an inheritance to your kids, how can you do that without ruining them? How do you do that so in a way that they're going to be responsible with it?
Oh, boy, isn't that the $10 million question? It is so difficult to imagine how poorly sudden wealth impacts some people. There's a reason why lottery winners wind up bankrupt. And it's because if you're not ready for sudden wealth, you don't have the tools and the training and the defenses really to not only take care of it, but also to protect yourself from predators and creditors. So when you leave money behind to your kids, number one, you want to leave it behind in a tax favored way. There's no point in giving money to the government you can avoid giving them. There's also ways to do this so that you can drib and drab this to your kids rather than having an avalanche of resources hit them at some young age. One is through trust planning. Your estate planning lawyer can help you with various types of trusts that might leave behind a certain percentage of that wealth over a period of time. And so there are ways to protect your kids from themselves. There are also just some education. I mean, if you're blessed to live till you're 85, your kids are in their 50s. So you're not talking about children now. They're your children, but they're not children. So as you have grown kids, as you have adult children, it's, I think, important to make sure that they're getting financial advice and that they're getting it in a competent way so that when any type of inheritance comes in, they will already have the tools, the resources, the relationships, and some of the acumen to handle it. I think open communication between generations is really important, and we encourage that. And it doesn't have to be a quantitative discussion. People don't want to tell their kids that they're worth X dollars. First of all, there's a lot of baggage around money. People are either embarrassed because they have so much or embarrassed because they have so little. No one seems to be just right. And as a result, people don't want to tell their kids about the money. Either they don't want to tell them that they haven't saved as much as they wish they had, or they don't want to tell them that they have so much money that they could ruin their kids and they never have to work again and they could turn into trust babies. So walking that fine line means when you have very young kids, it means having the right trust documents. It means naming the right parties. It means having the right lawyer. As your kids get older and are old enough to start making decisions, it means making sure they have a financial advisor who can but does not have to be your financial advisor, but that they have some advice with someone competent so that they're prepared to handle some of these decisions. And if you have kids where either you're concerned because they have a spouse who may or may not be a long-term member of your family, or they have issues with substances or gambling or just bad credit and bad spending, there are things you can do for a lifetime to try to protect your heirs from really spending everything you spent your whole life building in a very short period of time.
Yeah, and I mean, we talked about you have your daughter who's about to be a teenager. I love her. I think she's great. I would hate for her to be ruined. So I will just let you know right now, I am fully willing to take her inheritance and just become your beneficiary. I would do that for her. I
Great.
know
No,
I'm
that's very
selfless.
thoughtful.
You are
That's
so
thoughtful.
welcome. And if you're listening, you're welcome. You're welcome.
Mm-hmm.
Um, so now we've talked about the different ways that we can, the different tools we can use, but are there resources that we can use to teach our kids about money? Is there anything available online, or where can we find some of these tools to work through these ideas?
There's lots of them. And, the first thing I mentioned was nonprofits. We have a
Mm-hmm.
close relationship with Junior Achievement, both of Central Maryland and of the Eastern Shore here in our state. But Junior Achievement is an international organization that does financial literacy education on a nonprofit basis. And they work with elementary and middle and high school students. And it's a very cool organization, either to support philanthropically or to bring to your kids or your kids' schools. So Junior Achievement, I'm a big fan. In addition to that, there are umpteen books on kids and finance and so forth. One was written by Rob Phelan. He was a recent guest on our podcast, actually. And he wrote a book called M is for Money. And it's a very simple read for younger children. And I actually think it's the kind of resource that belongs in just about any household with kids, because it's an opportunity to bring up some financial concepts in a very non-threatening, non-super academic way, which is good, because if it sounds like school, it's going to sound like it's not fun. I don't know about you, Sarah, but
Yeah,
when I was reading as a kid, if I was reading for something I was interested in, I could sit and read all day. But if I was reading something on the summer reading list, I wanted to be anywhere else. So making this feel like something fun and something attainable and something you do together, as opposed to something that you force kids to do, I think is helpful. We
absolutely.
found we found there were not enough resources for young people, and so BFG has created some of our own. And so we have a personal finance course that is really an introduction to personal finance. Our younger advisors here in the office put together 8 modules, and it's just really well done. And it's available for free for anyone who wants to take it at bfguniversity.com. We've gotten a lot of really, really nice feedback from folks who had their kids watch that or who watched that with them, which is great. And it's very accessible, it's very interesting, and it's not difficult. Now, some of the lessons are around like choosing your benefits with your first job. So this is not for 8-year-olds necessarily, but it does start with basic savings. So I would say it's middle or high school or up. Lastly, putting together a library of resources is very, very important. And so brotmanmedia.com, we've put together a number of resources, including some that are free and available, articles, podcasts, and those kinds of resources, in addition, of course, to our books and our online courses that are not free, but are very, I think, affordable. So there's a lot of resources out there, whether it's for kids or for yourselves, and I would encourage folks to check them out.
Yeah, I think if since parents are going to be, you had said at the beginning, the first lessons we learn about money are from our parents. It can be really important for you to educate yourself and kind of go through some of those resources for yourself, so that you have more knowledge that you can pass down, instead of passing down that those negative lessons and those fights that you might have. So anyone that's looking for resources for themselves or for their kids can go find some of the ones that we put together at brotmanmedia.com. And now another topic that you had touched upon that I wanted to talk about was, when is it the right time to introduce your kids to your financial advisor, or should you introduce your kids to your financial advisor?
This is a really tough topic, Sarah, because there are lots of schools of thought here. I think it's important for your kids to know who your advisors are, so that if something goes wrong, and when I say kids, I mean grown kids. I mean kids in their teens or late teens or 20s or beyond. Know who your lawyer is, or your tax advisor, or your financial advisor, just so if something goes wrong, they can make sure they know where your will is or where your other legal documents or your accounts are and so forth. Um, but that said, most kids don't want to work with their parents' advisors. First of all, their parents' advisors are often older than their parents, which means they're of a totally different generation. I actually think it's helpful to have a financial advisor be younger than you in most cases, only because it means that we're likely to be there at the point in time where you need us for retirement or financial independence or beyond. It's also real
Great
helpful
point.
to have it's also real helpful to have advisors at different ages and stages in an organization so that you can really take care of a full family. So at BFG, we've got a legacy client program where we try to make sure that grown kids are able to get advice very inexpensively and potentially with someone other than me, because I'm the old guy in the corner office, whether I like it or not. And so, having your recent college graduate meet with somebody in his 50s, to me, it's lovely, but it doesn't make a ton of sense. They're not going to relate to me. So having them work with somebody in their 20s or 30s who speaks some of the same language and has some of the same experiences and is going through some of the same things more recently. If your kids are looking to buy their first home or to get married or they're starting a family of their own, all those things, which I can certainly speak to. I've been there and done it and written books about it, but it's been so long that I don't think I'm relatable to kids that age. And I think it's helpful to have them have their own person. Yeah, I wouldn't want my dad's doctor or my dad's lawyer or my dad's financial advisor. But it's great if a firm has the ability to work with multiple generations of the same family. It creates a lot of coordination. It can create communication to the extent you want it. There's a lot of benefits to having your grown children start to get advice. We talked about it earlier, which is it's nice for them to be able to handle anything you leave behind and to know that there's good stewardship and advocacy and so forth. But even beyond that, your kids need their own sounding board and they don't want to come to you about it. They don't want to ask you. I mean, kids who go to their parents to ask what employee benefits to choose, it is the blind leading the blind. And I say that lovingly, having done it myself when I got my first job out of college. My father gave me what I consider to be wretched advice on what to select and what not to select, not maliciously, but what he had me select made sense for a guy 50, not a guy 20. So I think it's real important to work with somebody you can identify with who has gone through some of these things, but is similar in age to you, if not a little younger, and who you can really build a relationship with over decades, because this relationship is as intimate as medicine, really. I mean, you talk about
Yeah.
everything together, and so it's an important place to start. And we've built a program that allows our clients um, to not only get their kids an advisor, but potentially even to pay for an engagement that is very, very inexpensive and that will create those foundations for learning about money. And it's been a really popular thing.
I will say, as far as parental shout outs go, I think I'm a little better at that. Your shout out wasn't as nice. The wretched advice.
Well,
Um,
it was wretched advice, and not on purpose, not maliciously. But
of
I
course
look
not.
back and the decisions that I made, I didn't maximize an employer match on a retirement plan. I didn't take advantage of an HSA when I could have. I didn't buy into the stock purchase plan at a discount when I could have. And I had the most expensive health insurance plan on the planet and was a young, healthy guy. It made no sense at all. And I
It
say that
doesn't.
lovingly. I say it lovingly, Dad, I love you. But that wasn't good advice.
Now, there's a lot of different ways to find financial advice. Can you talk a little bit about the traditional financial planner, the robo advisor? What do, if the people listening, if they have kids that are young adults, what is going to be best for them? Where should they suggest they go look for that personalized advice?
Well, I think first of all, if you have your own relationship with a financial advisor and you trust him or her or their organization, ask them. Ask them if they have someone in their organization who's right potentially for your grown children to speak to, even if it's just about a student loan discussion or about a first employee benefit discussion or something simple. I'd start there. If you don't have a financial advisor and you're looking for one for your kids, first of all, I think it's going to be a little tougher to talk your kids into working with someone unless you're prepared to say, well, I didn't, but it'll be good for you. And I'm not sure that resonates as well. There are resources to find an advisor right for you. The CFP board, which is the Certified Financial Planning Board, has a planner search feature. The Financial Planning Association and other organizations have features. You can do that. You can ask your accountant or attorney or realtor or banker or other professionals, insurance agents, other folks for a recommendation or two. I think it's wise if you get a referral, a recommendation to somebody, that's great. But if you don't, or even if you do, I think it's wise sometimes to interview a few folks. Find the person
Mhm.
right for you, and to have your kids, if you're interviewing them for your grown children, have a discussion with them about, do you want them to go by themselves, or do you want to be in the room with them to sort of help vet someone? Because unfortunately, there are, like any other industry, there are some terrific financial advisors and there's some really lousy ones who really don't do anybody any favors. And so understanding the difference between a fiduciary advisor or someone who's objective versus, for example, a salesperson matters. We actually put together a white paper, which is also available for free. And Sarah, you can, I'm sure, tell folks where to find that. But it's really an interview. It's the 10 or 12 or 15 questions, I think it's 12, that you can ask a potential financial advisor or even your current one to learn more about them. And it's more important than just what questions to ask. What do the answers mean? And it's not because there's a right answer or a wrong answer, a good or bad. It's because you want this person to be right for you in the same way you want your doctor to be right for you. You want your financial advisor to be right for you, and we're all different. And so interviewing a number of firms, asking the right questions, and then some of it's trusting your gut, but it's trust but verify. And there are ways to look up a potential financial advisor and disciplinary history or other background, licensure, or any kind of issues that also make sense. And they're on, every financial advisor has to have that prominently on their website, on their email signatures, every place. That you cannot, fortunately, you cannot hide being a bad apple as easily as you could for many, many years.
Yeah, there's definitely been a lot of improvement there. So the free download that Eric, that you just talked about, that's going to be found at broughtmanmedia.com/interview. And having those interviews and asking those questions are things that we've talked about a lot in a lot of different resources. You talk about it in your book, Don't Retire, Graduate. That's available on Amazon. You go into a lot more detail about those questions and why to ask them and what those answers mean. But you also just recently talked about those some of those questions on the podcast. I know you and Emily Guy Birkin had a great conversation about that and her take on what those questions should be. So definitely go listen to that episode. It's on Spotify. It's on our website, wherever you listen to podcasts. But those are some really great resources to learn more about that. So we actually did get a question that I would love for you to answer. It's a little bit off topic of what we're on right now, but when do you think teens should get their first credit card? I think that's a really interesting question.
Oh, it's a great question. I love that. And I think as soon as you have an 18-year-old who is eligible to get a credit card, they ought to get one. But they have to be very thoughtful about which one they get. It's important for the first card that you get to be a major credit card, not some kind of department store card or what have you. Have it be a MasterCard, a Visa, an American Express, Discover, something major. The reason for that is that your credit score, in part, is based upon the duration of your credit history, and your credit history
Mm-hmm.
begins with the first card that you get. So, I'm fortunate to have a 32-year credit history now because I got my first credit card, which was a MasterCard, which I still keep. And it doesn't mean you necessarily have to use it for the rest of your life. It just means have it with a major bank, have it be a major card, and leave it open. And of course, make sure you teach kids how to use it responsibly, because getting in credit card trouble is not something we want any of our kids to do. And it's real easy swipe it and not think about it until the bill comes, and then you're less happy about it. So I think as soon as a kid is 18 and eligible, it's worth doing, and doing with some guidance. Unfortunately, they're going to show up if they do go to college. They're going to show up their freshman year and be walking down. For me, it was Locust Walk in West Philadelphia, and it would be walking down this, and there's 15 credit card companies hawking what they're doing, and you really are cannon fodder unless you know what to do and how to do it. And so I think it's real helpful to start building your credit history right away, and maybe have your kids use their card once in a while for something small and pay it so that they have not only a history of having credit open, but a history of payments too. That's only good for your credit score. When they go to buy a house 10, 15 years later, that kind of stuff will matter, and it will help them if you help them do it right. Great
Is
question.
there
Thank
a
you.
way that, yeah, is there a way that you can add them to maybe one of your credit cards before they're 18 and start building that history?
You can, but it's still your account. So I know there's some people who like to do that. I prefer not to see that necessarily. I prefer to see kids as soon as they're eligible to do it themselves, have it in their social security number, and build it themselves. Now, while we're on the topic of credit, lots of people use credit monitoring services, whether it's Credit Karma or LifeLock or some of the other monitoring, or whether it's just checking your report at the various credit bureaus. Kids under 18 don't have credit reports, but they do have social security numbers. And so unfortunately, what criminals have learned to do is to, if they find a social security number of a 5-year-old, they will literally hold on to that until the kid is 18, and then start hacking up their credit report before they even know what happened. And so I think it's important to do if you're going to do a LifeLock or or Equifax or Experian or TransUnion, or whether you're going to use one of your cards, include your kids on some kind of family plan to protect their social security number. Because unfortunately, criminals are always sort of one step ahead of law enforcement. It just seems that way. And so you don't want your kid to be 18 looking for their first credit card and already have a mess to clean up.
Yeah, it's great advice. Um, so one of the things that um, people often think about with financial advising is that it's not accessible to people with less than like $1 million. And I know, speaking for my generation, not a lot of us have that. So if as an adult child, um, is there a way to obtain, you had mentioned our legacy program, is there a way to obtain this professional advice without having to worry about that asset minimum?
Well, yes. One of the questions in the interview, when you're going to ask a firm or an advisor, you're going to ask who their typical client is. And there are
Mhm.
firms that have published minimums. There are firms who won't talk to someone under $25 million, which
Ouch.
rules out a fair amount of the population. The reason why firms have minimums sometimes is related to their delivery of services, or their deliverables in general, or their price points. Sometimes it's related to capacity, and every firm is a little bit different. And so finding your sweet spot and finding a firm that's right for you matters. We started a program called Financial Planning for All that creates a basic financial plan for folks at a really accessible price point, even if they don't have assets to manage. So at our firm, we've been real happy to work with folks on asset management, but there's stages before that occurs. There are young people who have nice incomes and have tax issues and are starting families and buying homes and doing these things, but the only investments they're doing are within their own company's 401k. So they don't have assets to manage for someone. Well, we're happy to work with those folks on a flat fee basis or a retainer basis, so that we can provide good guidance and good advice and help them with those decisions, even though we're not managing assets. And we're not the only firm doing that kind of thing. But if you go to financialplanningforall.com, you'll find a whole lot more about what that type of planning includes. And you can use that to compare to maybe the advisor you're working with, or some of the others you're interviewing. What's included in an engagement like that? It's different than private wealth management, but young adults don't need all that, and they certainly shouldn't be paying for something they don't need.
Sure. Um, again, everyone listening, feel free to send in more questions. We've got a few more things to cover, but we've got 10 minutes left, so I know we're going to have time for at least a question or two, so feel free to send those over. One of the ones that came in that I really think is a great question, when we're starting to plan for our kids and plan for their future, is there a way to protect those savings from inflation?
Well, inflation is on the tip of everybody's tongue right now, and
Yeah.
unfortunately, a typical savings account or savings vehicle won't keep up with inflation. It never would, and it certainly can't under current circumstances. Um, in order to protect your assets from inflation, what you have to have is you have to have a real rate of return. You have to have a rate of return on your assets that is greater than inflation, so that it's not only keeping up with the cost of living, but it's also growing, because otherwise it's a stagnant place. You know, the value of a dollar today isn't what it was 20 years ago, and it won't be the same 20 years from now. In fact, it might not be the same 20 months from now. So it's important not to sack it in necessarily a savings account and forget it, because while it's important to have cash, it's important to have resources and what I like to refer to as dry powder. It's important to have access to capital when you need it, but you must outpace inflation, or you're not growing your actual wealth.
Sure. I know when I was a kid, I remember getting savings bonds. Is that still something that parents should be looking into for their kids? Is that like a safe route?
Well, it's funny, for a long time I told people not to bother, but right now Treasury Direct looks pretty impressive. I mean, there's some, because of inflation and because of the need for that capital, there are ways to look at Treasury bonds right now, and yeah, I think it's worth exploring, especially since it can
Mhm.
be done in a fully online way now, and you're not going to wind up with a stack of these things you have to take to the bank and sign in the presence of other people. You know, we saw people who had, like, you know, suitcases full of $10 and $15 and $30 savings bonds. But today it's possible to open an account. I think the limit is $10,000 per person per year. And you can do that, and you can get a return. There are restrictions on when you can access it, and how long the interest lasts, and so you need to do a little research about it. But I actually found it to be quite easy, and it is worth looking into. It's an option. Certificates of deposit for a long time have paid nothing, but with inflation, we will see higher rates of return on CDs, and so it may make sense to start exploring that as well. There comes a point. CDs are nice because they're FDIC insured typically, and they have some safety, as you alluded to. But you normally pay a price for that safety too. The price is the upside. So it's worth looking at all those options, either with your advisor or on your own. Good question.
Yeah. Now, for a lot of people, when they have a pretty substantial amount of savings themselves, it can be easier to save for their kids. Do you have any tips or ideas for people that maybe are at a lower income or lower asset level? Like, how are they still able to prepare their kids if they're not in that really comfortable financial space themselves?
It's difficult. It's very difficult because all resources are finite, and everyone has
Sure.
finite income, finite resources, finite wealth. And of course, the fact that it's finite, some certainly are in better shape than others entering into a conversation like that. I think there's really only two ways to improve a financial situation based on cash flows, and that is to earn more or spend less. And that sounds really basic, but it's true. And so if you have the ability to earn more, either because you're hourly or you have overtime or there's a side hustle or second job you're looking at, that can make a huge difference. The other thing is to figure out how to spend less and take a look at the things that add up. I'm not one of those guys who says skip the latte every morning and you'll be wealthy. I think it's important to live your life and to do the things that are important to you. You just can't do it all. And so,
Mhm.
making some decisions around budgeting, we've done programs for employers, and one of the tenets of that program is pay yourself first. So at whatever income level you are, unless you are spending more than you make on basic necessities of life, in which case this won't apply. But if you have enough income to pay your bills and most months there's something left over, instead of just hoping there's money left over, pay yourself first, start contributing to something regularly, even if it's a savings account, even if it's a small amount of money. Start doing that so that you learn to live on, hopefully comfortably, less than 100% of your income. It's the only way to start building actual wealth. And if
Sure, and yeah, you can.
if your cash flow is negative, then you basically are filling a bucket that has a hole in it, and the hole's bigger than the spout. So it doesn't make sense to do it that way. Yeah, you have to try and make sure you don't have adverse debt. You have to try and make sure that you have positive cash flow, and all of this is in our book and in some of the various resources that we've put out, because I think these are really important basics of personal finance.
Yeah, and I do want to point out that this was a family webinar and you said the B word.
I said the B word, budget. Correct.
Yes, you said the B word. Someone just sent in, it's not a question, but I think it's a really great point. He said, for lower income folks, I find that it's important to de-emphasize the dollar amount and celebrate the fact that savings is happening consistently. And that is such a great point. And I know we talk a lot about not so much the dollar amount you're putting away, but the percentage of your income. Can you talk a little bit about saving a certain percentage and how that changes as you grow your income?
Well, a percentage is great, but to our participants' point, I totally agree. A lot of it's basically forming good habits and celebrating the fact that you can put away something, even if it's incredibly modest. I despise rules of thumb. I just think rules of thumb are like a garment that's one size fits all, which means it fits no one properly. That said, it's important, first of all, to have positive cash flow, and then as a target. And you can calculate a target with your financial advisor to know exactly what you need to put away, but as a target between the dollars you're putting away for yourself and the dollars that your employer is putting away on your behalf, I would love to see every human be at 15% or more. So if your employer's putting in 3% to your 401k, you need to come up with 12. That's not easy to do. And I don't think this is an all or nothing game. You don't have to go from, boy, I'm saving nothing to 15%. Start at 1%. Go to 2 and bump it up every year automatically if you can, so you don't forget. Bump it up every year so that if you're fortunate enough to get an increase in your compensation, putting away a higher percentage of that higher compensation won't hurt as much. And it'll wind up starting to build real numbers, and it becomes, unfortunately, you mentioned traditional advisors versus robo advisors, and some of the computer programs have gamified investing, and I think they've done it in a really inappropriate way, where you get badges for making trades, and that to me is celebrating the wrong thing. I like what our participants said about celebrating that you're saving anything, especially if it's automated. If you have a paycheck and you're able to take $20 a check and have it go to a different account than your primary checking account, it's $20 a check better than you were doing before. It's $240 a year if you're paid once a month, or double that if you're paid twice a month, of course. And while that may not buy buildings and it may not, quote unquote, retire you, it's a habit that once you're in it, you'll keep it. And I think that's great advice.
Well, we only have 2 minutes left, and I don't know about you, but I don't like homework. So I do not want to leave these people with any homework, but I do love extra credit. So I know we've got 2 extra credit assignments for everyone that's listening to this webinar. The first one, visit bfguniversity.com. We had talked about this before. We created a free personal finance course. It's an introductory course that covers a lot of the things that we mentioned here, which is basic savings and credit and understanding how to use credit cards and student loans and all of that. Completely free. Enroll yourself or your kids or both. And that is a free resource available at bfguniversity.com. We would love to have more students taking it, and send us feedback. Let us know what you think. And then our second assignment, Eric, I'm going to let you take this one. What should people do?
If you have an interest in having a conversation with one of the advisors at BFG, just hover your phone over that QR code, and you can actually get to a scheduling link, and you can schedule a call with one of our 8 advisors. And we'll see if maybe we're the right firm for you or you're the right client for us. And if not, we'll do our very, very best to point you in the right direction and make sure you land in a good spot. So we'd love to hear from any of you, either by email or on social media or through a phone call. And if you want to use this QR code, that's a great way to get in touch with us.
Yeah, and if anyone has questions about setting that up or has questions that they didn't ask on this webinar or didn't get an answer to, feel free to reply to all of the emails that got sent when you registered. Those will go right to me, and I will either be able to answer them myself or I'll connect you with one of our advisors who can answer those questions for you. So that is our time, and it's 12. Thank you guys so much for joining us. I hope you learned a little something, and I'm excited to see you guys for our next webinar in a couple months. Y'all have a great day.